Good evening, everyone. Welcome to our UC Riverside Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. We're going to allow everybody to kind of get in the Zoom room. We have quite a large attendance for tonight's class, so we're going to allow everybody to get in. While we're waiting for our class to start, just want to give you kind of logistics of tonight's class. So this is a very interactive workshop, so we encourage questioning as we go through tonight's class. So you can use the chat function as we're rolling through tonight's class. We teach these classes about once a week over video across the country. This class is going to be kind of focused in on first-time buyer, first-time homeownership, specific to some of the Southern California markets, but we do serve multiple states here from our office here in Sacramento, and we're really excited about our partnership with UC Riverside, which we've had that partnership for the last 3 years. So let's go ahead and dive in. I know some of our audience members will catch up to us. Again, my name is Jason Maida. I'll be your presenter for tonight and answering your questions on air. And like I said, as we roll through tonight's content, really encourage you to ask any questions. We'll answer those on air. We look at this workshop as kind of just an opportunity to help educate you on what's probably going to be one of the largest purchases you make in your upcoming financial futures, really. And there's some exciting new things that are happening across the market in California. We're going to be able to share those with you tonight. I've been in the business for over 20 years, helping educate first-time home buyers, and we specialize in the CalHFA assistance program. So some of you that are attending tonight's class may have heard about the new California Dream for All program that just launched on Monday. We're going to talk about that tonight. So if you're tuning in to learn some more information about that tonight, we're going to get a chance to cover that. We've been teaching classes on the California Dream product for about a month now, and we're really excited that got a chance to launch this past Monday. Just in case you haven't heard of that program, it provides up to 20% of your sales price in down payment assistance. So a really cool option for first-time buyers. So we're the leading provider of the CalHFA assistance program. So we do spend some time in classes talking a little bit about that, and we'll kind of cover that toward the latter part of tonight's workshop. So what are some of our other talking points tonight? Well, we're going to look at the housing market. We're going to talk a little bit about what's going on with kind of our upcoming spring season of home buying. We'll look at interest rates and what those are doing right now. Hopefully, we've kind of seen the tip of the iceberg when it comes to interest rates. We're hopefully going to see interest rates start to come down a little bit. We'll talk a little bit about credit. We'll look at obligations like student loans. How does that impact our qualifying? We'll look at various loan programs that are available to you as first-time buyers or buyers in general. We'll look at some of the documentation usually needed for home buying. And we'll also look at that assistance program, like we talked about, the California Dream product, as well as some of the other programs that are available to you as first-time buyers. And then we'll wrap up tonight's class looking at the process of buying a home. What does it look like to get pre-approved for your home purchase, go through the home search, and ultimately, how do I get to the end result, which is obviously getting the keys to my house? And we'll talk a little bit about a consultation and how we kind of help educate our clients. We spend our days meeting with clients one-on-one, designing home buying options for them so they can partner with a realtor and get a chance to go out and look at different homes that fall within their budget. So tonight's class is going to run just about an hour, including our Q&A. If we need to stay a little bit extra to answer any questions or over time to answer questions, we'll certainly do that. We want to make sure we give you all the information you need to help you with your decision of home buying. And so when we think about home buying, it's probably going to be, like I said, one of the largest investments we make in our upcoming financial futures. And, a lot of our clients come to us, just kind of maybe just trying to understand home buying and what it looks like, whether it's credit, whether it's savings, what it's budgets. We want to help kind of be that partner for you on that path towards home ownership. And when you think about buying a house, there's some really cool benefits that come with it. The ability to be able to kind of control your budget and affordability. You can create wealth in the growth of equity in the home. This is an asset, so you have the ability to be able to pass along this asset to the heirs of your estate. And there's still some great tax benefits that come along with owning a house. And so when we think about doing like a comparison of renting today versus buying today, it's not necessarily an apples to apples comparison. And to kind of illustrate that point, I want to jump into a quick calculator that we use, and it's our rent versus buying calculator. And it's brought to us by Freddie Mac. And all the tools, by the way, all the presentation and resource tools that we're going to share with you tonight's class we're going to forward back out to you via email. So, we have all of your email addresses from signing up from today's class. So all the material that we go over tonight will also be available to you. And we also we'll have a recorded version. Every class that we have taught over the last probably 3 or 4 years are all on our YouTube channel. So we encourage you to kind of check out those. We want to keep you up to date with all the latest information when it comes to home buying. So let's just walk through this analysis of renting versus buying. And so this is it's an interactive kind of type calculator. I'm going to build out a scenario that we can kind of talk through, and then you'll have a chance to work on this on your own, maybe as a homework assignment, if you will. So let's just assume we're spending about $1,750 a month in rent, and that, our monthly renter's insurance is about $15 per month, right? And then let's say that our rent increases by about 3% per year. And then looking at that rent situation, then we compare it versus owning a home. If we bought a house, let's say in Riverside or San Bernardino County, maybe I went to LA County for $450. I do realize that all these price points are going to look a little bit different depending on where you're at. But let's say it's a $450 purchase price. Now, the minimum down payment buying at $450 is 3%. And that's for a conventional loan product. Now, there's going to be some assistance programs that are available that we'll talk about, but generally for just standard traditional conventional loans, it's a minimum down payment of 3%. And then we also have to save for what we call as closing costs. Now, in buying a house, you also have property taxes, which we have factored in here at $5,500. Usually we budget for about 1.25% of the sales price as the tax rate, but taxes do vary based upon where you're going to buy. We have homeowners insurance. We have the maintenance costs of the home. We're also going to plug in our loan information. So in this scenario, we have a 30-year fixed mortgage. We assume an interest rate of 6.5%. We're going to talk about interest rates in just a minute, kind of what's going on there. Origination charges, those are going to be the costs of your lending charges. Now, what's really great, in a partnership with UC Riverside, we have a discounted origination charge, which lowers our processing fee from $910 down to $160. So if you're part of our UCR alumni or any of our other partnerships, we pass along that discount to you. Now, discount points are going to be costs that you can pay as a consumer to help lower your interest rate. So let's say today's interest rate is 6.5%, but I really want to achieve an interest rate of 6%. You can increase your costs and then do what we call as a buy down of your interest rate. So those are in the form of discount points. Usually one discount point equals 1% of your loan amount, and that'll help lower your interest rate about 0.25%. Other settlement charges are going to be like title and escrow fees, government charges like recording fees. Those are all going to be part of our closing costs. Now, what I would recommend when we budget ourselves for a home purchase, we want to save up at least enough money, of course, for our down payment. And then we want to factor in about 2 to 3% of our purchase price for closing costs. Now, the other assumptions we want to make in this calculator, we put in appreciation rate of 3%. We have 10 years that we're going to be in this house. Could be, of course, a lot less. We have our selling costs of our home. Now, just a quick side note, when you buy a home and you're represented from a buyer's agent or a realtor that represents you as a buyer, their commissions are paid for by the sellers. So it's not something you have to worry about as an expense. However, when you turn around and sell your home, let's say 10 years from now, then you'll be responsible for those agent commissions at that time. So that time when you sell your home, the proceeds of your home will be after you've paid for the buyer's agent that represents that buyer, as well as the listing agent that represents you. So we also add in state and federal taxes, and then we have the savings rate. Of course, that has changed a little bit with what's going on with inflation, but we'll talk about that in just a minute. So if we were to side-by-side comparison this and take the total cost of renting, so we know our rent's at over $1,700 a month. Now the buy side puts us over double at $3,800 a month. So again, not a fair apples to apples comparison, but the total cost over time, over 10 years, we actually benefit by buying by $28,000 over those 10 years. That would help me save $28,000. Now, of course, interest rates aren't at the lowest levels we've seen. And so certainly if there's an opportunity to perhaps, like, let's say, refinance our home at a later point in time, we could certainly do that. And that would enable us to be able to maybe lower our payment and, of course, create more savings, more opportunity for better savings, I guess, over the course of time. So the rent versus buying calculator, I think, is a great way to be able to kind of really see what that side-by-side comparison looks like for you. Okay. And again, I'm gonna have all those tools sent to you tomorrow morning, so we'll get those in your inbox. All right, we're gonna continue on here, and I want to spend some time talking about the housing market. We're going to talk about it specific to the Riverside market. And the market here in Riverside doesn't look much different than other areas that we teach classes in, whether it's LA County, Orange, San Diego, into the Bay Area, Sacramento County markets, all looking fairly similar. Homes staying on the market a little bit longer, sellers maybe overpriced, and now they're having to maybe retract a little bit on prices. You can see the average days on market ballooning to about 65 days on market, so much higher than we saw year over year. Last year, obviously, interest rates played a big role in that. Rates are starting to come down a little bit, which is super helpful, especially going into the spring buying months. Some of this is a bit seasonal, seasonal. So as we're kind of looking at the spring buying, we're starting to see, maybe a little bit of lift here in prices, but overall, the median price across the Riverside County market's about $590 in median sales price. Now, most of our buyers are probably buying around the $425 to $450 level in the Riverside market. Now, I think as we look further back in what we've seen here going into 22 is obviously interest rates rising, elevated levels. We saw rates top out around 7.25% last year. That obviously affected the housing market, pushed buyers more towards the sidelines. Homes sat on the market a little bit longer. And, we're still kind of finding our way through that. And, I think the spring buying season, at least what we're seeing, is probably going to pull a lot of that days on market down quite a bit. And interest rates are also cooperating. So that's going to be the major component of our home buying plan. And, interest rates today are right around that 6.5 level or so. This blue line represents what 30-year fixed mortgages have done. And, as I just alluded to, we saw interest rates really rocket up in 2022. Interest rates topped out at about 7.25%. We saw inflation, start to, be a real problem. It still continues to be a problem. And the Federal Reserve trying to combat that with, the elevation of the federal funds rate. Just last week, the Federal Reserve elected to raise the federal funds rate 0.25%. There was thoughts prior to the 2 weeks leading up to that we would see a 0.5% increase. But many of you have saw what has happened in the banking sector with SVB Bank in the Silicon Valley, as well as Signature Bank, having issues, we'll say, and challenges. And I think part of that Federal Reserve decision on interest rates was probably driven a little bit behind the banking sector and what the problems is going on there. I think ultimately, there may be a pause at some point because we may have kind of reached a tipping point with the kind of the escalation of interest rates. So there's all kinds of theories on where interest rates are going. I think ultimately in the mortgage space, we're really trying to see interest rates kind of level out a little bit. And I think we've seen a little bit of that. And so this slide kind of represents what we're seeing in the activity levels with mortgage interest rates. So if we could kind of push this slide out a little bit further, we're probably still about this level when we look at interest rates in the month of March. Now, let's go back a little bit because I think everybody wants to know, hey, what happened to the 2.5% rates? Why can't I still get that? Well, obviously, we talked a little bit about inflation and the Federal Reserve raising rates and what that's done to the mortgage interest rates. But when we look back at 2020 and obviously the start of the pandemic, we saw rates crash to 2.5%. Obviously, could create some frenzied buying behavior given what was going on with all the uncertainty in the world. And so that 2.5% rate level obviously created a lot more buyer interest. And then as interest rates kind of escalated, we started to see the buyer activity to slow down a little bit. But as I'm looking at this upcoming quarter, so we call it the second quarter, so April through June, we're really starting to see buyer activity pick up quite a bit. I think interest rates are helping with that. I think, weather hopefully will start to get nice here pretty soon, and we'll probably start seeing more buyers in market. Now, all interest rates aren't created the same for each buyer. So there's characteristics that go into an interest rate. There's credit eligibility. So generally, if I'm a 740 credit score or higher, I'm going to get the best available interest rates. My loan product will play a role, how much I finance, what my down payment is. We talked a little bit about cost or points. Those discount points are part of the equation for interest rates. And the term of a loan can also affect my interest rate. So typically with first-time buyers, we're going to have a 30-year fixed mortgage. But the shorter term I have, the lower my interest rate can potentially be. Okay. Now, not often I'm going to be a first-time buyer going after a 15-year fixed mortgage product because I'm going to more than double my mortgage payment. So not always super realistic to be able to help to create good affordability. So most programs we're going to recommend would be a 30-year fixed product for most first-time buyers. Okay, I gave you a lot of information already, and I was kind of going maybe a little bit quick. So I just want to kind of slow down for a second. And do we have any questions so far on some of the information I've shared? I know we've had quite a few recently just joined the Zoom class, and it will probably commute times or whatever might, probably slow you down from getting on tonight's session. So I want to kind of just see if there's any questions from the audience that I can kind of backtrack and cover. Okay. All right. Again, if you have any questions, we're gonna try our best to answer as many of those on air, because many of your fellow students in tonight's class may have the same questions. So it's always great to share those with the group. Now, I want to talk a little bit about credit. When I look at the couple challenges that maybe first-time buyers have, it's centered usually around two things. It could be credit because maybe I'm just kind of overextended, or I just, maybe struggling with my student loan debt, or it's savings and I just don't have enough for my down payment and closing costs. Now, we're going to talk about assets and savings a little bit later in tonight's class, but let's spend some time looking at credit because it's our goal to help support you in getting your credit on that path towards home ownership. Now, many of you probably monitor your credit through Credit Karma or Experian, Equifax, maybe TransUnion. And what you're seeing in those credit scores that you receive is a credit card score or consumer model. When you apply for a mortgage, it's going to be more of the mortgage model. So let's take a look at the score calculation for the mortgage model. So if we look at, and we kind of look at this chart here, we have 15% of the score is how long I've had credit. So the more mature my credit file is, the higher my credit score is potentially going to be. The second component and 20% of the weighting is in-use credit. So those are new accounts that I'm trying to open up. So if I've opened up 5 accounts in the last 12 months, that's probably going to impact our credit score a little bit more if as opposed to maybe I haven't opened up a new account for 5 years. The other part of that is going to be inquiries. Now, in starting our process, we start with a soft inquiry, which does not impact your credit score. So after tonight's class, if you think you want to kind of get on the path towards homeownership and help you put together a plan, that is only going to start with a soft credit score. Now, a hard inquiry is where you're going to be impacted there. That eventually comes down the road once you have an accepted offer with a property, but we start with the soft credit check. Now, 30% is going to be, and this is probably the biggest area of opportunity for most buyers, is amount owed, which is also known as credit utilization. So when we look at our outstanding credit limits versus our credit balances, the credit utilization is going to play a big role in that. So if I have $10,000 in limits and $5,000 in balances, then my utilization is 50%. We always recommend our clients to try to get as low as 10% or less than 10% utilization. So ideally, having my balances below $1,000. Now, let me give you a quick tip when it comes to managing utilization. So if you were to go tonight and look at your credit card statements, there's a billing cycle date that will show on those credit cards. The billing cycle date is the time at which the credit card issuer will send out the data on your balances, your payment history, your minimum payment out to the credit bureaus. So ideally, if you can try to pay down or pay off that balance before the end of your billing cycle, you're going to have a much more favorable score when it comes to applying for your mortgage or any other, credit product you're looking at. 35% is going to be how I paid my bills. Usually the bureaus will rate your credit payment history, and if you've had any late payments, at 30-day late, 60, and then 90-day lates. And any lates you've had in the last 12 to 24 months are going to be the most impactful to your credit score. Now, every product has a minimum credit score requirement. So FHA loans, and by the way, you're going to learn a little bit about products in just a minute, but each product is going to have a designated minimum credit score. So it's 580 for FHA loans, 620 for conventional loans. For our veterans that are eligible for the VA products, 620. For the CalHFA first-time homebuyer products, it's 640 for FHA, 680 for conventional. Okay. So we had a question that came in around student loans. So we're going to talk about student loans in just a minute. I have a whole slide centered around that. So we're going to be there in just a minute. So I definitely will answer that in just a second. Okay. And then, a couple of the things I just want to kind of focus in on credit scores or credits in general. So, past challenges like bankruptcy, short sales, collections, late payments, those are all going to, obviously play a role in impacting your credit score. Usually when you've had past challenges in the most recent 12 to 24 months, that's going to be the most impactful to your credit score. Account closures. So if you take a revolving credit account that you've had for 10 years and you close that out, the challenge with that is that when you close out that account, it's kind of pulling away all the great history you've had on an account. So when we look at, how long I've had my credit, if I close out a 10-year account, it's going to kind of hurt my score from the length of credit, but also could potentially impact my utilization because now I have less credit limits available. And in lending, we always look at the middle credit score for all three agencies. So when we look at Experian, Equifax, and TransUnion, if I'm 760 is my high score, then I have 740 and 720. 740 is a score that we'll use for qualifying purposes. Now, if I'm applying with my partner and my partner has a 700, 680, and 660 score, the middle score of my partner is 680. So we go off the lowest middle score between both borrowers. So just something to kind of keep in mind that as we're kind of strategically putting together what it looks like for your home buying, that's how we'll kind of evaluate credit. So the question that came in just now was, how has COVID-19 changed the way that lenders look at credit? So, I like to say that it's changed, but there's some guideline changes from the pandemic as it relates to how we have to evaluate income. But there isn't really any rules around if I've had late payments as a result of the pandemic. There's no exceptions, if you will, for late payments or, the biggest thing I think we see with the pandemic is around forbearance when it comes to student loans. And we're going to talk about student loans in just a second, but that's probably the major thing that we've seen is just, how do we evaluate qualifying when it comes to accounts that are not requiring any type of payments. Now, negative items that appear on your credit report, you heard me mention earlier that the most recent 12 to 24 months are going to be the most impactful to your score. Now, this slide's going to kind of relate to how long will they stay with me on my credit. So credit inquiries are 2 years or less. If I've had late payments, collections, judgments, those will be there for 7 years or less. Now, there is a new credit rule coming out for medical collections, and that hasn't been quite adopted yet. We're waiting to see some updates on clients' credit reports, but if you've had medical collections, they should not be appearing on credit reports. Bankruptcies will generally be there for 10 years. And then for student loans, or federal debt in general, it could be there indefinitely. Now, the question around student loans, I think, is a big one because most of our clients will have student loans as we design their home financing. So even though federal student loan debts, there's obviously legislation out there to create forgiveness. There's forbearance right now that basically doesn't require you to make payments as part of the CARES Act and the pandemic. But as lenders, when we're designing home buying options for our clients, we do have to take into consideration minimum monthly payments for the student loans. So there's different ways that we'll look at that. And we have a few examples on the slide here, which is, if I have $75,000 in student loan debt and I'm in a repayment program, or let's say I was in a $250 per month IBR or income-based repayment amount prior to the pandemic. Well, if we can document that, then that's the amount that we're going to use for qualifying purposes. Now, I do have some clients that have graduated in the middle of the pandemic, and so they haven't signed up for an IBR payment. So in that case, they would have to either sign up for an IBR payment, or on a conventional loan, we take 1% of the balances, and that's the payment amount we use. Or for an FHA loan, we take 0.5% of the balances, and then that's what we use for the payment. Now, we do have some clients that are in student loan forgiveness. So let's say you're in the healthcare industry and you're set to, if you work for this particular medical care provider for 10 years, then there's forgiveness. That does happen. However, if there's a balance existing right now, we still have to count a minimum amount for the student loan payment. Now, if you're back in school, like let's say you're working on your master's program and your student loans are deferred, we still have to count a minimum payment for you with qualifying on the student loans. Now, we had a question on auto loans, and so I'll kind of backtrack a little bit. And the question is, how do regular loans like car loans affect your credit score? Do they use utilization rates like credit cards factors? So they don't. So utilization is only revolving debt, whereas car loans are installment debt, or personal loans are installment. And so personal loans, car loans, when you pay them off, generally they're not going to create too much disruption to your credit score. But if you obviously miss a payment or anything like that, that could impact your score. When you take out personal loans, especially consumer finance loans, what I've seen is those can lower your credit score. So if you take out a SoFi personal loan, or you take out Upgrade or Upstart, whatever, some of these online lenders, those can at times impact your credit score. I think more so what we're looking at with the installment debt is like, how recent have we taken out the installment debt? Now, if buying a home is in your near-term future for your finances, we'd encourage you to connect with us about designing a plan, because we wouldn't want to run out and obviously get a new car payment, because that could ultimately impact our eligibility for our home purchase. So it's really important to kind of have a plan put together and see, where are we looking to buy at? And then if we do want to purchase relatively soon, if I have to make that purchase for a car, does it still work with my home buying plan? Now, with products in home buying, these are the 5 kind of core products that we usually talk through with clients. Now, there's other products, but for our classes that we teach throughout the year, these are kind of the ones we focus in on. So the conventional loan, when we think about conventional loans, those are Fannie Mae, Freddie Mac loans. FHA loan, that stands for the Federal Housing Administration. VA loans is the Veterans Administration. Those are for our veterans that have served and have eligibility for the VA product. And generally for a veteran, they'll have a certificate of eligibility to get access to the program. And then USDA is going to be for clients that are looking to purchase in kind of more rural areas. Some of our more desert communities would be possibly qualifiable, like Joshua Tree, I think, is a USDA eligible area, and they're basically designated on the USDA website. That provides a zero down payment option, and that seems pretty exciting for clients that are looking to purchase in those areas. It has to be the right product, because not only is there geographical restrictions with the USDA product, but there's also income restrictions with that loan as well. And then jumbo loans are going to be for clients that are looking to purchase beyond the conforming limit of $726,200 for Riverside or San Bernardino County. Now, if you're joining us from LA and you really want to buy in LA, when you buy over $1,089,000, that'll push you into a jumbo loan category. So loan limits vary by geography. So Riverside and San Bernardino County have those limits at $726,200. Now, jumbo loans are for those clients needing additional financing. Not always are we going to see first-time buyers venture towards that product suite, but it is available. The difference is the minimum down payments are much higher, usually 10 to 15%, and they do carry with it reserve requirements, because on top of having a higher down payment, you do need to have additional assets, which we call reserves. Reserves generally would be 12 times the amount of your monthly payment. So if you have a $5,000 mortgage payment, 12 times that would be $6,000. Okay. Now I want to kind of spend some time looking at conventional and FHA loans, because for the most part, when we look at our clients designing their plans, that's usually the suite of products we're looking at. As we heard earlier, the conventional loan has a minimum score of 620. It has a 3% minimum down payment. And you can put as much as you want down, of course. Once you hit 20% down on a conventional loan, there is no mortgage insurance. And we're going to talk about mortgage insurance in just a few minutes. And then the FHA loan, again, Federal Housing Administration loan, not designed just for first-time buyers. It can be second or third-time buyers. Minimum down payment of 3.5%. And then for those loans, they do carry it with it mortgage insurance. Now, there was an adoption of lower mortgage insurance rates about 3 or 4 weeks ago. However, FHA loans, regardless if you put 20% down or not, it does carry with it mortgage insurance. So when we look at mortgage insurance on a conventional loan, there's a couple different ways you can pay mortgage insurance. There's monthly MI or mortgage insurance. There's split mortgage insurance, and that gives you the ability to pay some of it up front, some of it in your monthly payment. There's single premium, where you figure out what the fixed amount is, so the out-of-pocket amount is, and then that is paid up front through your closing costs. There's lender-paid mortgage insurance, and that's where you take maybe a slightly higher interest rate that allows you to buy out your mortgage insurance. And then with PMI, it's not a one-size-fits-all, similar to interest rates, because it's based upon credit score, the amount of your down payment, and then how much you decide to finance. Now, one of the options with conventional mortgage insurance is that once you reach 2 years in your loan and you have 20 to 22% equity in your home, you can apply to cancel your mortgage insurance without having to do a refinance, for example. And that seems to be a popular option for clients once rates start to come down. And we've talked a lot about that with clients for like future planning. If we were to look at a conventional mortgage insurance option, and let's say we financed $450,000 and we had a credit score of 740 with a 3% down payment, that private mortgage insurance is about $183 a month. Now, for those of you that are doing your searches on Redfin or Zillow, and you're already kind of start looking at homes in the market, a lot of those payment calculators that are offered on those sites are not kind of aggregated to, or calibrated, I should say, to these different characteristics of mortgage insurance. And so you can see, like in the same scenario, like $300 and $400 monthly mortgage insurances, which obviously changed the dynamic of the budget pretty significantly. Now, FHA mortgage insurance, when we look at that, as I mentioned to you, there's some amendments to the cost of mortgage insurance. This amount here of 0.55, it used to be 0.85. So they recently brought that down, which is fantastic for our buyers that do go the FHA route, because it's saving them a considerable amount. On average, it's saving clients $100 to $150 a month. And so there is two components to FHA mortgage insurance. There's monthly mortgage insurance, which is that 0.55% factor. But then there's also upfront mortgage insurance, and that gets added on to your loan amount. And the way FHA mortgage insurance works is that there is no cancellation option. So even though when I reach that 20% equity mark, or I have 2 years or 5 years in the home, the only way I'm going to be able to cancel mortgage insurance is by refinancing out into a conventional loan product. Now, if we look at the PMI for an FHA loan and we take that same $450,000 loan amount, the way FHA mortgage insurance works is I take the $450,000, I need to add on upfront mortgage insurance. So I take 1.75% of the $450,000, which is $7,875. That gets added on to my amount financed. So now my total loan amount is $457,875. And then when I use that upfront mortgage insurance add on to my loan amount, my MI comes out to $206.25 for FHA. So it's slightly higher than conventional loans, but you are adding on that upfront component and then not having the cancellation option. So when we step back for a second and we're kind of looking at our product options and thinking what works best for me and my family, FHA, you may say, gosh, it seems so expensive. It just doesn't make a lot of sense. Seems like conventional is about to go. And maybe it is for some clients, but not everybody qualifies for conventional products, because not only is there credit score differentiators, but there's also underwriting guidelines that each product has. So for example, in fact, I was talking to a client earlier this morning, she has a bankruptcy that will not be discharged 4 years until 2025. And in that scenario, the conventional loan would not work for her right now, because she's looking to purchase, now. Whereas FHA would absolutely allow that, because conventional wants to see that bankruptcy discharge 4 years, where FHA is at 2 years. So scenarios like that may lend a client to choose one product over the other. If I had a missed payment on an American Express account and, it was just an error, maybe a conventional loan, it might be a little challenged, especially if it was in the last 12 months, where FHA would be okay with that. So all those different kind of nuances of the product will have a client look at one option or the other. Okay, so now the next component to our home buying plan is looking at documentation that the lender, is going to ask for. And by the way, just in case I didn't mention earlier, so our organization, we're a direct lender. So we're in the top 10 lenders in the country. And so, we are lending as a direct lender our own funds, so to speak. So, in the mortgage space, there is 3 kind of different types of channels you can work with. You can work with a mortgage broker, which is going to be like the middle person between you and the access to the funds. There's a banker like a Wells Fargo, Chase, B of A, kind of a one-size-fits-all type of situation. And then there's what we call us as a direct lender or mortgage banker. So we have all the attributes of a bank, but without the banking relationship. So it's just strictly mortgage. Okay. So as a mortgage lender, we're going to ask for certain documentation. If you're a W-2 wage earner, we're going to ask for the last 2 years of W-2s, recent pay stubs, and then we do a verification of employment. We usually want to see 2 years of work history and or education. Now, it is conceivable that maybe I've only been on my job for a month, but I just graduated from UC Riverside, and now I'm, starting my accounting profession after getting my accounting degree working on my accounting degree for the last 4 years at UCR. And that would fulfill the 2-year requirement. So a lot of misconceptions I hear out there is that I don't have 2 years work history, so I can't get financing, which is not the case. It's a combination of education and work history. Now, if I've, let's say I have 2 jobs. Let's say I work in the healthcare industry and I work full-time at one clinic and I work, 20 hours at another. As long as I can demonstrate that I've been with both jobs for 2 years simultaneously, then I can use both sources of income. So that's one of the rules where the 2-year requirement does take effect, where we have to be able to show that if we're looking at using dual roles or dual employment, I should say. We have a lot, we had a question about kind of the pandemic and how's it changed lending. I think this probably brings up a good comment, which is, unfortunately, we've had clients, that have lost employment because of the pandemic, right? In 21, we've had some layoffs. And so question that comes up is, well, can I still get financing if I lost my job in 21 but now I'm back to work in 23 or whatever the case may be? And the answer is yes. I mean, we'll have to explain why there was a gap in employment, but there still is opportunity to get financing even with that change of, status, if you will. Now, if you're doing dual employment where you, let's say, drive for Uber as a part-time job, but then you have a full-time job, and you want to count the Uber income, you just have to show that you've been doing both jobs simultaneously for 2 years in order to count both sources of income. And then another question that comes up is job transitions. In fact, I was talking to a client about this earlier today. So if I'm working on a job right now, but I have an opportunity to work for a new employer and it's a higher wage, when can I count that new income for my qualifying? So the answer is once I have an executed offer letter, we can factor that new income into the qualifying for your mortgage product. Okay. Now, for self-employed individuals, the documentation requires a little bit different because we're going to need to see absolutely the last 2 years of taxes, profit and loss statement, balance sheet. We also need to verify the business and kind of its status through like a business license or a CPA letter. So the requirements look a little bit different for self-employed individuals. Now, for your loan application, when you're looking to get qualified, only the applicants that are on the loan we can use those sources of income. So if I'm the only one on the application, but my spouse truly has income, but is not going to be a part of the application because of credit or whatever the case may be, we can't count their income unless they're actually on the loan application. Okay, so I had a question that came in. It kind of backtracks a little bit to student loans, which we can certainly talk about. Are lenders more likely to want to see IBR payments over a span of months, or at least that a plan has been established and started? So the answer is just a plan that's been established and started. So, that's all we would need. And so, to my kind of comment earlier, we have some clients that did graduate within the pandemic, and so they don't have an income-based repayment amount. So if, we have $100,000 worth of student loan debt and we don't want to count that 1% amount because it's $1,000 and could negatively impact the qualifying, in that scenario, a client may want to apply for an IBR payment just to see if we can get that payment a lot lower based upon their income. Okay, so speaking of income, this is a calculation that lenders use called the debt to income ratio calculation. I think a lot of clients are familiar with it. But simply put, it's your gross monthly income versus your monthly obligations. And usually we don't want to see that exceed more than 45%. So we wouldn't want our gross monthly income or obligations to basically consume more than 45% of our pre-tax income. Now, in some cases, we can go higher than 45% because some products will allow us to go even to 50%. But we got to really kind of figure that out to see if that makes sense for a client, because at the end of the day, for us in designing financing for you, we want to accomplish two kind of really important goals. One is we want home buying to be sustainable for you, that you can carry on in the future, but we also want it to be affordable. And so when we look at debt to income ratio, that's just a qualifying component. It doesn't necessarily indicate where your affordability is at. So when I meet with clients and they feel comfortable at 33%, well, great, that's where we need to be. Where some clients say, hey, I'm comfortable at 48. but everybody's situation is a little bit different, but it's really important for us to get you to more of an affordable level for homeownership. So this is the debt to income ratio calculation. So we take the principal and interest, the taxes, the insurance of my new house that I'm buying. We take the PMI that I have because I'm putting less than 20% down. If I'm buying a condo, if I'm buying a townhouse, sometimes with single family residences, I'll have HOAs or homeowners association dues. Let's say that's $2,500 a month. And then if I have another $500 in additional debts, maybe a couple credit cards, a personal loan, whatever the case may be, if I take that $3,000 in debt divided by $8,500 in pre-tax income, then my debt to income ratio is at 35.2%. So when I work with first-time buyers, I get the question of, well, what do you think is a good debt to income ratio? And so I don't really have a gauge on what's good or bad. I think what most first-time buyers feel comfortable at is 33 to 36% debt to income ratio. Now, it's our role during the consultation with you when we design home buying plans is to make sure we're designing the right product for you, and we'll review debt to income ratio with you as well. Now, the last stop on our way to building our home buying plan is to talk a little bit about assets in savings. I mentioned to you earlier, there's two challenges, right? For home buyers, usually it's credit possibly, or it's just lack of savings because maybe we're just getting our financial footing, if you will. And so maybe homeownership hasn't really been on our radar. Now, when we think about the documentation of assets, there's a few things that we need to have in file. We need to have the last 2 months of statements for our asset accounts. We do need to verify any large deposits that have entered the account. That's really important. Retirement accounts, if you've started retirement accounts, they can potentially be used like 401ks, 403bs, maybe even an IRA account. But I would encourage you to talk to your financial advisor, maybe your tax advisor, because accessing those funds could impact, market value of those accounts or could create tax consequences. So we really want to be careful there. Gift funds can also be used. Now, gift funds are where a family member is contributing to your home purchase. It can't be a friend. In fact, I had that question earlier today. I want a friend that wants to help out. It has to be an actually family member to be able to gift funds. Those funds do not need to be seasoned for a home purchase. Usually, if it's funds coming from your own account, it requires a 60-day policy or 60-day seasoning period, which is why we ask for 2 months of statements. But for a family member, they can gift to your transaction right away. But it does require documentation like a gift letter, which we have a template for that we would give the donor to be able to complete. And then they would provide support that they have those available assets. And then, of course, they would wire those funds to either you or to what we call is the escrow company. And you're going to learn a little bit more about escrow in just a minute. All right. Now, when we look at assets and trying to save, it's a challenging thing, right? Because we have to get together down payment funds. We have to get closing costs. And in some cases, that can be $25,000, $30,000, which not all first-time buyers have. In fact, most clients that we consult with probably have $8,000 to $12,000 available for their home purchase, so which won't be enough. And so when we look at options to help first-time buyers, we are really thrilled to partner with CalHFA, which is the California Housing Finance Agency. You may or may not have heard about this organization. You're probably seen it in the news quite a bit, especially this week, because we just launched a new program. I'm proud to say that our team is the #1 provider of the CalHFA product across the entire state. So whether clients buying up in Sacramento or buying down in San Diego, we've provided the most CalHFA products. So I want to spend some time looking at the first-time buyer program and kind of what that can do to help make homeownership a reality for you. So I'm going to first spend some time looking at some of the staple products within the CalHFA suite of products, and then we're going to look at one of the new products that just launched this past Monday. Before I do, I want to answer one question that came in, and the question was, can pension income be used for qualifying? So the answer is yes. So you can absolutely use pension income. So there's a documentation process for that, which we can help you through. So I want to first look at the two CalHFA products that are available, which the first one is the MyHome Assistance. For a conventional loan, it provides 3% of the sales price in assistance. For a FHA loan, it's 3.5%. Now, what these are low interest loans at 1%, and they do not need to be paid back until a borrower either sells the home or if they decide to refinance in the future. Okay, so it's a low interest loan at 1%. So when we think about that example I gave you earlier at $450, 3% down payment, you could potentially have that entire 3% covered through the assistance program. Now, there's another add-on to the MyHome Assistance program. So if we, want to get our down payment covered, but we're still running a little bit short on available resources. The ZIP assistance program provides 2 to 3% of your loan amount for additional closing cost assistance. And what that is, it's a zero interest loan that also gets provided by the state. So if you need help with your down payment, MyHome would help support you there. And then if you still need additional support, that's where the ZIP assistance program can come into play. Now, I will say most of our clients that elect to use the MyHome program don't go with ZIP, at least right now in today's rate climate, because it really elevates the interest rate when we add on the MyHome or the ZIP assistance program. Today's rates for the MyHome product are 6.5%, but when we add the ZIP assistance program, it'll actually push that rate closer to 7.5%. So the trade-off is probably a little too great with interest rates. So when we design plans with that particular product, I always recommend maybe taking a look at just maybe the MyHome assistance program. So let me show you an example of like how this would work looking at a conventional loan. So we talked about the $450,000 sales price example earlier. 3% is our minimum down payment, which is $13,500. You heard me mention about closing costs earlier. So we're going to have those estimated at $9,000 to $13,500. So I'm probably going to need about $22,500 to $27,000 if I traditionally purchased my home. So if I took a standard conventional loan, minimum down payment of 3%, I need $22,500 to $27,000. Again, most first-time buyers don't probably have that much in resources available. So if we took the MyHome assistance program, now we get that support for that $13,500. We add the ZIP assistance program of 2 to 3% if we wanted to. Again, probably not the best move right now with today's interest rate market. But conceivably, if we didn't take the ZIP, we could potentially buy our house with as little as $9,000 to $13,000 out of pocket, because now we're just focused on just paying the closing costs. And maybe that's a little bit more attainable for us versus trying to put together as much money to cover, the first example up here. So those are the kind of the two staple products with CalHFA. So those are always available. Those are part of the CalHFA budget. We've helped hundreds and hundreds of clients with those programs. And then throughout the year, the state will add on different products. Last year, we had a program called the Equity Builder program that had a limited amount of funds. And this year is no exception. So on Monday, we launched the California Dream for All program. I'm happy to say I was part of the project team that helped develop this product over the past 8 months, and really, really excited about the final product that we were able to deliver to the market. And there is an incredible amount of interest in it. We're just trying to keep up with the call volume and email interest that we have. And there really is, something that's a game changer for our first-time buyers in California. We all know, whether you're in Riverside, LA, Orange County, Sacramento, the Bay Area, it's very expensive to live in California for several different reasons. But when we look at the cost of housing, the ability to be able to have 20% of your purchase price in assistance to help you with your home purchase is an incredible opportunity. And that's what the California Dream for All program does. So it's a shared appreciation loan where it allows you to get up to 20% in assistance. And in exchange for that, you have a shared appreciation agreement with the state. So we're going to go through some examples in that. I think we have some slides to walk you through. Let me see if we have our, so we don't have our full shared appreciation slides, but I will tell you, we're going to send you some follow-up information on it, but I'm going to kind of give you a high level what that looks like. Because we actually have California Dream for All specific classes. In fact, I would encourage you, if you have some time, maybe not tonight, but in the next couple of days, check out our YouTube channel. We've had, I think, over 6,000 views on our different videos that I've taught classes on the California Dream for All specific to this program. But it's a one-to-one shared appreciation. So if I buy a house for $500,000 and I get 20% in assistance, so I would get $100,000 in assistance. That is interest-free assistance, not required to be paid back until I either sell my home or if I decide to refinance in the future. The program guidelines do allow me to refinance one time within my term without having to pay back that 20%. So that's kind of a cool feature there, but it does need to be required to be paid back on that refinance or sell. Or if I go the full 30 years of my mortgage, probably won't happen, but there is a shared appreciation agreement. And what that means is that if I buy my house for $500,000 and let's say 7 years from now, I sell my house for $550,000, now my home has appreciated $50,000. And when my home has appreciated $50,000, the state would share 20% of that, which would be, you would be paying out $10,000 at the time of sale, in addition to the $100,000 that you received at the time of purchase of the home. And somebody just asked how to find that class so we can watch it. So I'll get the link sent to you guys so you can check that out. If you just want to search my name, Jason Maida, you should be able to find me on those videos. They're available on our website. I'll post in the chat a link to our website. You can check out all of the great tools and resources. I'm going to kind of go off script a little bit here, and I'm actually going to take you guys to our website, make it a little bit easier for you guys to see. So give me 1 second. I want to show you some graphic. We have some really, I think, helpful graphics on our website that you can check out. Now, this program is a first come, first served product. And what we mean by that is that the program requires a registration. And the registration cannot occur on this product until you have an accepted offer with a seller. So let me just take, like I said, I'm going off script a little bit here. So, and I know we have some questions popping in. So this is our website, which I think is a really great tool. It kind of just shows you just all the different CalHFA products. Really proud of what our team's done here. If you click in the California Dream for All product, we have all the guidelines here for the program and some really great examples and some of the eligibility requirements. And so, you guys can check that out at your time. I know we don't have a lot of time to go through that in tonight's class because this is kind of an overall home buying class. This is the example I was sharing with you earlier, which this is not the same example, but the same mechanics, which is, I buy my house for $500,000. I receive a $100,000 assistance loan through the Dream for All program. Now, when I go to sell my house, and this example is probably a little bit excessive, but if I go to sell my home for $640,000 5 years from now my home has appreciated $140,000. So at the time of sale, the state would share in $28,000 of that appreciation, and then I would pay back the 20% loan that I received. So I would pay back $100,000, which is shown down here in your payback, $100,000 for the principal assistance I got initially, and then the shared appreciation of $28,000. And so our website kind of goes in to show a little bit more about, the shared appreciation example. So you can see a little bit more about that. And then this is our YouTube video. So I think for those of you that wanted that in the chat, we'll get that. We'll copy that link for you, put that in the chat there for you. So it looks like, so it's already there. So it should be there for you guys. Okay. Okay, so we answered that question. Okay, so question which hopefully I made that very clear. So APM is a mortgage lender. So our team here, we do consultations in mortgage. So when we think about consultations, it's us designing home financing for you so we can ultimately help you with your mortgage. So we would be the one lending. And so the way it works with the California Dream for All product, we are lending on behalf of the state, and that loan is officially sent out for servicing with the state servicing. So let me show you an example of how this program could really just be a game changer for home buying. So now we got the same $450,000 example. We all know the math there. So let's incorporate now the 20% assistance. So now when we add this 20% assistance, that enables us to do a few things. One is we're going to be able to take and put 20% down payment, which absolutely eliminates mortgage insurance. And then if we wanted to, we could actually take some of that 20% and split some up towards our down payment, some towards closing costs. So in essence, we would be able to cover virtually almost all of our out-of-pocket expense, with the exception of what we call as an earnest money deposit, which you're going to learn a little bit more about that in just a few minutes. And we'll kind of talk through that. So let me just answer a few questions. Can you share how to find? Okay, we got that one, so that's good. Is there a dollar cap to the shared appreciation that is paid back? Yeah, so it's 150% of the original purchase price of the home. The shared appreciation, honestly, is something where I wouldn't recommend keeping the shared appreciation loan for the full 30 years. You're probably going to go through a triggering event of either selling the home, which triggers it, refinancing, or then of course the 30 years. But once the shared appreciation is paid off, or the initial investment of, let's say, 100,000 in my example, then at that time of payoff, then there would be an estimate of the shared appreciation that's owed for the program. Now, what's different about this program, and you'll hear this in some of my training videos that you get a chance to watch, is this: most funds for state programs in CalHFA come under CalHFA's budget. This is from the general state fund budget. And so that's why we have about $150 million this year allocated, possibly another $150 million next year. I say possibly because originally the program started out with $500 million being allocated towards it, and then it kind of shrunk down to $300 million. So I think it's a little bit of subject to change. So if it's something you're interested in, and there's many clients that are interested in, because we've got a ton of calls on this, you do have to get pre-approved and be able to start the home buying process. And then in order to get reserved for your funding for the program, you do have to have an agreement or an accepted offer with a seller. Here are some of the eligibility requirements for CalHFA. So the California Dream for All program has a minimum credit score of 680, which we don't have it specified here, but 680 for the conventional product, because this only works with a conventional loan, the California Dream. And if you're considered low income housing, which is you're making less than 80% of the median income, it's a 660 requirement. We can go up to as high as a 50% debt to income ratio. Income qualifications on CalHFA loans are based upon the applicant information, not the total household size. And so why that's important is because there is income limits for this program, which I'm going to show you in just a second. They're usually 150% times the median income in that particular community that you live or that you're looking to buy. And then a first-time buyer is someone that hasn't purchased in the last 3 years. And single-family homes, new construction, condos, townhouses, BMR homes, which are below market homes, are eligible. Manufactured homes are a little different because they have to be on land that is owned. So those are all kind of important features. Now, the product is only good for a 1-unit property. So if you're looking to buy, a duplex or something like that, that would not be eligible under these programs. And then these are the income limits by county in Southern California. So that'll give you some kind of perspective of the product and kind of who's included. These programs are far more lenient from an income perspective than most first-time buyer programs. Most are at 80% or less of the median income. So like for example, in LA County, I think it's like $72,000 would be the maximum. Whereas as you can see here with CalHFA, you can make up to $180,000 in LA County. Okay, hopefully you found that pretty exciting. Again, check out the California Dream for All training video. I think that is super good information. And we can talk more about any questions as we wrap up in tonight's class. I know we're getting pretty close to the top of the hour, so I do want to take you through a couple things, and hopefully you guys can stay with us a little bit longer. These are our 6 steps of home buying on this journey towards home ownership. So after leaving tonight's class, and you want to kind of sit down and figure out what a game plan could look like for you with home buying, we would then look at a consultation and design home buying for you, a home buying plan. And the output of that consultation will be for a pre-approval. Now, a pre-approval is basically it's a certificate that's presented to a seller that shows that you're qualified for your financing. Now, we just had a question that came in, and the question was, is it a soft inquiry for a pre-approval? And it is. So we only start with a soft inquiry right now through Equifax just to determine your eligibility for the product. And as long as you meet the minimum qualifications, then eventually when you have an accepted offer, we would do a hard inquiry for your financing setup. I'm going to answer this quick question. I'm going to keep us going down the 6 steps of home buying. But the question is, can you repeat the income cap for California? The income limit is 80% of the median income. Is the table you showed 80% or median? So what the table that I showed you is the actual income limits. But my point was that most programs are at 80% of the median income, which CalHFA doesn't do that. So when we look at the CalHFA income limits, this is what we have here. Now, CalHFA does have a low income housing limit, which is 80%. The benefit there is it gives that buyer like a lower interest rate. Step 2 in the process is going to be house hunting. That's where you get a chance to go out and look at homes. And we have several clients that are out looking at homes right now, especially because the weather's starting to turn, get a little bit nicer, a little more daylight. We would encourage you to talk with a realtor during your home search. We have preferred realtors all across California that can help support our clients. As I mentioned earlier, realtors are paid for by the seller. So I really encourage you to take advantage of that resource. And once you find that home that works for you and you decide to make an offer, now, if that offer gets accepted, then we're going to move to step 3, which is called entering escrow. And I'm proud to say we've had quite a few clients enter escrow today. That means that they've come to agreement with the seller and now they're in the escrow process. Usually the escrow process will take about 25 to 30 days. So that's basically from the time of acceptance to the time I get my keys, it takes about 25 to 30 days. Now, within 24 hours of your accepted offer, we're going to give you a call and say, congratulations, talk to you a little bit about what to expect next, and also get you set up for your follow-up consultation that you do with me over video to make sure that your financing is designed the way you expect it to be. And that usually occurs within 2 to 3 days of your accepted offer. Now, what also occurs within 2 to 3 days of your accepted offer is the requirement of an earnest money deposit. And that deposit is usually 1 to 3% of your purchase price, depending on your contract and where you're looking to buy. Those funds will count towards your total out-of-pocket expense, like your closing costs, for example, or maybe your down payment. Now, if you're electing a program like an assistance program, you still would have to contribute your earnest money deposit. The assistance does not cover that deposit. So we'll do your follow-up consultation at that point. We'll go over all the design of your financing. We also order the appraisal on your house. And we start the kind of the process, and the output of that consultation, that follow-up consultation, will be now to move your loan to the next phase of processing. Now, I mentioned to you a little bit about the earnest money deposit. Here's a slide that kind of shows you the 1 to 2%. I said 1 to 3% because we do have some areas like the Bay Area here in Northern California. We see a lot of 3% earnest monies. What happens with the earnest money deposit is that money is being deposited and put on hold with the escrow company. And that money is protected by what we call is the contingency period. Now, the contingency allows you to do your due diligence on the property and allows you to kind of do your homework to make sure this is really the good fit for you. And usually the contingency period is in the first 14 to 17 days of your contract period. So that includes getting your house appraised. We want to make sure the value of the home supports what you're buying it for. We want to make sure you get the house inspected to make sure there's no, mold issues or a roof falling off or a cracked foundation, anything like that. Then, of course, we want to get your loan approved. And as I mentioned, those contingencies are in the first 14 to 17 days of your contract. And why that's important is because your deposit is protected during that time period. So if something goes awry with those inspections or your loan approval or your appraisal, you can still cancel the transaction and get a full refund of your deposit. So super important. Now, I mentioned to you a little bit about the processing of the loan. That's where our team, verifies your employment, your assets, kind of goes through all the administrative tasks of your loan. Probably have your loan interest rate locked in by that time. If you're doing an assistance program, we'll have you registered with your program. Like I mentioned earlier, the California Dream product is a first come, first serve product. So we really want to jump on that registration and interest rate lock as soon as we have an accepted offer. And then from step 4, we move into step 5, which is loan approval. And that's where an underwriter gets an opportunity to review your loan, make sure it all fits the credit criteria and the kind of the underwriting matrix for that particular product that you've elected. And once we've got that loan approval, it's also going to bring us to the end of your contingency period. So by that time, we have your appraisal back, you got your inspections, and your loan is approved. And so if everything checks out, then you're going to be okay with removing your contingency. So that tells the seller that you've done all your investigative investigative work, I should say, and that you feel comfortable in moving to the very final stages of the process. Now, important to note that once you lift your contingencies, now you kind of have your deposit exposed. So if you decide to change your mind in a couple of days, you could risk losing your deposit. So you really want to consult with your realtor, make sure you're feeling good about everything before you make that final sign off. And as a lender, we're going to deliver to you a final closing disclosure at that time. And what that closing disclosure does, it gives you a 3-day cooling off period before we get to the very final stage, which is kind of a happy day, not the happiest, because the happiest is when you get your keys, but this is when you get a chance to sign your final loan documents, because by that time you're almost through the entire loan process. You sign final documents in person with the public notary, which takes about an hour. The funds that you have remaining for the closing of the transaction, whatever that might be, is deposited or wired or given via cashier's check at that time. After you've completed those two tasks, then as a lender, we wire in the funds for your first mortgage. If you've elected any assistance, we also take care of that at that time. The escrow company will reconcile those funds to make sure you've contributed everything you're supposed to as a buyer. The seller is receiving the proceeds they're expecting. And after that has all occurred, they'll release documents to record with the county recorder's office, whatever respective county you're buying in. They usually record a grant deed, which transfers ownership from the seller to you. And then they record a deed of trust, which is your agreement to repay the loan. And so once they have recording confirmation for those two instruments, then you become the official owner. Then that's the big day, because that's when we get a chance to give you a call and say, congratulations, you did it. We get an opportunity to do that at least once a day for our buyers, and super proud of, all the work we do to help our clients through that process. Now, many of you joining tonight's class may say, wow, that's a lot of information. And, I'm trying to kind of wrap my mind around it, and rightfully so. But it's a journey that will help kind of guide you through. And to begin that journey, we start with a consultation. And that consultation allows us to design home buying options for you. And it's about a 30-minute session. We're doing some condensed versions that are 15 minutes right now because we've had a lot of interest in the California Dream product. But, we love to be able to connect with you out of today's session. And we call it our Get Started information, where you complete an online application, you upload proof of income and assets, and then we meet with you over video to design one of those programs for you. Now, if you have some questions coming out of tonight's workshop and you want to schedule an intro call with myself or one of our team members, we carve out 10 to 15 minutes to just kind of answer questions for our clients that are looking to kind of figure out what the next steps might look like for you. Here's what that consultation looks like. Again, it's a free consultation. We only do a soft credit check at this point, but we're taking the time to design a home buying plan for you, figure out where you want to buy, what your budget looks like, go through different product options. And then, like I said, the output will be to have you pre-approved if you want to kind of start that path towards home ownership. I meet with clients that are buying next month, some are buying next year, some are like 2 or 3 years out. This is kind of part of the mortgage planning process to get you into home ownership at some point in time. We have some fantastic resources like our mobile app. So it's available for Android and Apple. You can start the application process right there, follow the different milestones in the process. Really great tool. Also, we see a ton of our clients using the calculator, especially as they're online or maybe shopping for homes over the weekend to kind of run their payment calculation. So a really, really awesome tool. And, as we're kind of coming to the end of tonight's class, we're really proud of our partnerships that we have, not only with obviously UC Riverside, because we're really proud of what we're doing here in our community, but across the country. Our alumni partnerships continue to grow, and we get a chance to just support more future first-time home buyers in home buyer education. So if you have friends, family, maybe coworkers that are interested in attending one of our free classes, they can always register for an upcoming class at mortgageeducate.com. And I know we've already kind of talked a little about some of our library of videos that are out there. So check out some of that stuff, including maybe past workshops. And we will have this class recorded as well for you. It has been recorded, and that'll be available for maybe you to do a look back as well too. So with that said, we come to the end of tonight's class, and as I wrap up, here's all my information. So if you do want to reach out to me, we'd love to be able to answer any questions for you. And I would encourage you to kind of do a little bit of research about our team and what we do to help support our communities. We value home buyer education. We consider ourselves a leader in home buyer education. We take the time out every Wednesday night to meet with clients all across the country to design home buying plans and help you with the largest investment you're probably going to make in your upcoming financial futures. And we've had several hundred of clients that we've helped over the course of the years, probably thousands, I should say, but check out what they have to say with us in some of our Google reviews, some of our Yelp reviews, and we really try to provide really good content on our social channels. Really proud of the information we put out there. So we encourage you to follow us on Instagram. We try to make sure that we're posting at least once or twice a week on things that are really relevant to you as first-time buyers. So with that said, before we wrap up, I do want to open up the lines for more questions. If I have anything that we haven't covered tonight, you guys have been a great class, but wanted to see if there's anything that maybe we missed that we want me to kind of cover before we end tonight's class. Okay, maybe we're good. Let's see here. Okay. think we're good. Well, oh, let me see. We got a question. Okay, you're very welcome. Thank you. You're welcome. Okay, a lot of great feedback. I really appreciate that. And I do realize, it's a Wednesday night, probably not the the thing that you really want to do on a Wednesday night, but we do appreciate you joining tonight's class. Hopefully you found this really important. Again, if you have friends, family, maybe some coworkers that think they would really benefit for our future classes, please check out mortgageeducate.com for all of our upcoming classes. I look forward to helping you guys in the future. Talk to you soon.